Welcome back to Accrued Interest. For this update on March 5th, 2025, I'm going to explain how short sellers can lie with data, particularly in the case of AppLovin. As always, everything said on this podcast is for entertainment purposes, as I am not a registered investment advisor. Now, while normally I would advise you to do your own research and ignore the shorts, sometimes the lies that short sellers put out are just too much and you need to investigate further. A favorite strategy of short sellers is what's known as flooding the zone. Flooding the zone is when you put out such an abundance of misinformation that all you end up doing is just creating confusion and spreading distrust between a company's investor base and the company itself. When the shorts came out, they came out with 4 scary accusations. They said that AppLovin was engaged in accounting fraud, that they were using gift cards to do some offshore tax evasion. They also said they were doing Chinese espionage and that they were giving sexually explicit advertisements to kids. Any one of these accusations independently is probably enough to make you not want to hold the stock. So they just overwhelmed many shareholders to make them sell without investigating if it was true. As I mentioned before, short sellers bank on the concept that we at Accrued Interest call NRD. They bank on nobody reading the documents for the stocks that they own. Another tactic short sellers rely on to scare you is by deliberately lying about stock option vesting. Fuzzy Panda and Culpa Research came out yesterday and they claimed that an AppLovin executive was dumping $64 million worth of shares in the open market because the company was in trouble. I'm going to show you how you can read the actual SEC filings and understand that this is not exactly true. I recommend that you go to the SEC website, and I have a little circle here where you should double click under ownership disclosures. Once you pull up what's known as a Form 4, which is a form that executives use for insider buying and selling, I want you to go all the way down to the bottom to the section called Table 2, where they talk about derivative securities. What often happens here is an executive will get a lot of stock options or RSUs as part of their compensation package, and then over time, as those stock options vest and eventually become in the money, they're going to have to sell them either for tax purposes or to diversify their portfolio. That is exactly what happened in this case. The 200,000 shares that this executive had sold actually came about because he had 200,000 stock options that were struck at $5 a share. With AppLovin stock over $300 a share, it's perfectly normal and not nefarious at all for this executive to sell to pay his taxes or for other general corporate purposes. Keep in mind that not all short sellers are white knights. They're not necessarily here to find the truth or to bring companies to justice. Often, all they want to do is just scare you away from their shares and they can move on to the next target. So I suggest that if a short seller goes after your company, do not overreact. Make sure you investigate each claim independently and verify it on your own. As always, thank you for listening. Don't forget to like and subscribe and stay tuned to the Accrued Interest YouTube channel for more updates.